watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Ricus Reeders from PSG, Hole-in-One, Ruimsig, Graeme Körner from Körner Perspective. Be sure to send your questions. Email stockwatch@bdtv.co.za, SMS 41392, or on X Business Day TV using hashtag Stockwatch. Gents, appreciate the time today. I want to go to some numbers and updates. Let's start with AVI. Ricus, they managed to do what they're best known for, which is keeping margins. Revenue up 1%. They managed to get HEPS almost 9%. But make no mistake, neither of those are thrilling numbers in the world, with I suppose maybe an SA Inc. world they are. Your take on AVI and the results and the prospects for it?
Yeah, it was a good set of results, as we can expect from the company and its management. The disquieting thing was the outlook for the rest of the year, which was not encouraging at all. It's nothing new. It's consumer spend and the optimism from the Government of National Unity not yet reflecting in the economic environment they operate in, and they've managed to, as you said, push their revenue up. They've controlled costs. They managed to pass some price increases through to the consumer, which gives you the which leads to this result. But the share down about 3.5% on those, and I think it's purely because of the outlook, not because of the operations in themselves. And if you compare it to something like Tiger Brands, we were talking about Tiger Brands on this program a week or so ago, where they've got lots of things to improve, whereas whereas AVI is running as well as they can, which I think also explains the difference in the price momentum between the two companies. But yeah, it's a good set of results, but in this market and in their market, not good enough for the share price itself to shoot the lights out.
No, I take your point, and I particularly like they're running excellent. Where do they sort of improve? Graeme, your take on AVI, as Rick has said. I mean, good numbers, tough environment might not get better in a hurry.
Yeah, Simon, I think Rick has summarized it very well. I think the one thing I would add is, with inflation running at about 3%, let's call it 9% HEPS growth. You're still getting real of 6%. It's not bad.
Yeah.
We all kind of calibrated for 5 or 6% inflation, then suddenly 9 doesn't look so good. So I think it's decent. But I think what Ricus is saying is exactly right, that you've got a business that's well run, it's well positioned, and probably not a hell of a lot of levers that they can pull. Obviously, Tiger Brands has to kind of reinvent itself and do a lot of sort of soul searching, repositioning themselves, but they have that optionality. Whereas I think if you just look at the business model in AVI and the businesses, not nearly as many levers I don't think that management can pull there. I think one thing I would add is if you look at it, I think on the historic of 14 times PE, 9%, the peg is quite a bit over 1. So I think that might explain why the price has come off. But I think generally it's not a business that I'm mad about. I think a little bit too, if you think about exotic or very high price shoes versus fairly affordable biscuits and coffees and things like that. For me, it's always been a bit of an eclectic mix of LSM groups. So I think there are other players, but I think, as you guys have both said, disposable income's not going to get better, and arguably a lot of that is sort of quite discretionary.
Yeah, and you forgot to add the fish fingers into that eclectic mix of products that they have. The other set of numbers, Graeme, will stay with you a second. Mpact results out. Here we saw revenue up, just shy of 4%. HEPS taking a hit. They do say that they saw better conditions in Q4, but a tough set of numbers. Your take on Mpact?
Yeah, I haven't really had a proper look at them, but I think it's a very, very difficult space. Packaging generally, we've seen, obviously, Mpact kind of reinventing itself, being the phoenix rising from the ashes. But even if you look at the one that we like globally, which is Mondi, it's a very, very tough space. So I think that's kind of the backdrop, and you can see it. The share, obviously, if you go back exactly 5 years after COVID, it's had a good run, but it's basically been going nowhere for the better part of 4 years. And I think that's just really reflecting a very competitive environment, and one in which yeah, I suppose your customers are keeping you very honest, and it's quite difficult to grow either top line or margin because people are keeping you honest. So yeah, I think it's just a very, very difficult space, but I unfortunately didn't have a good enough look at the results to comment. But I think, there's a lot of businesses that we've seen where unfortunately top line's not even beating inflation or just beating inflation, but the costs are obviously eating away. And I think that's a similar story in this one.
Yeah, it is costs in many parts. Ricus, your take on Mpact?
Yeah, what Graeme said in a nutshell, and specifically that share price going nowhere for 4 years, it's just a reflection of the environment that they are operating in. They've been doing some change, getting rid of Veripack and building new plant, that kind of thing. In other words, making themselves more efficient. But if it's packaging, if you're not an Mpact where you're rediscovering the wheel and getting the company ship shape, there's not a heck of a lot you can do if your Mpact and your operating environment is stagnant.
Yeah, that was always my early days of the market. Packaging companies are when GDP is booming. We don't have GDP, never mind booming. A question coming through asking you about the MultiChoice, the Körner Plus deal. Question is, should I sell my shares at 107 in the market, currently about 108.5, or keep and take the 125 offer that will come through at the end of the year? It looks like 16% return with little risk. Ricus, the logic's unless the deal falls apart.
Yeah, well, that's the outside risk, and then the other question is if you think that's locked in and everything else being equal as far as the rand's concerned and that kind of thing, then yeah, if you think you can do better elsewhere, sell now and go and invest there. If you think you're not too worried about the deal falling apart, then and you're satisfied with the return you're going to get, then stay with it. It's a wishy-washy answer, but that's all I can say, really.
Yeah, I mean, it is. I mean, Graeme, anything to add? I mean, it is the answer. We don't know what the future is.
I think I've said this many times on the show, so sorry for boring people, but MultiChoice is worth more in Körner Plus's life than it is as a listed company. So personally, I think at $107, given all the streaming services and all the content that's available in other formats, I think the business model, if they didn't do a deal with Körner Plus, would be a shrinking violet. I mean, big violet to start with. But so I think against that backdrop, together with the fact, Simon, I look at a lot of listed companies that we like, and quite a few of them are small and mid caps. 16% upside sounds great, but there is some forecast or deal risk there. And, I would argue that you could probably buy a few companies on fairly under-margin multiples where there's probably, if you put it on a fair exit with decent earnings growth over the next year or two, you're going to do better. So, I would say there are, I believe, better things to do with the money, notwithstanding the fact that 16% is a good return over 10 months, but I am worried about the deal risk. So I would personally cash in and look to redeploy it.
Yeah, and I take your point. You can get, 16% is a good number, but it's not an impossible number. Question coming through about Pick n Pay. Graeme, next day with you for this. Medium-term buy, they've got the EPE partnership, which should help. I don't know if people switch because of their bank's loyalty program, but Graeme, Pick n Pay for you?
Simon, they've got a lot of work to do. Obviously, they've been losing sight. So, in a way, they need to sort of get back to their knitting and kind of reinvent themselves in what has become a very, very competitive space. We keep saying that, Shoprite has really eaten everybody else's lunch. So I think, it's not just about Pick n Pay fixing themselves. They've got to fix themselves and be competitive against, powerful businesses that really are have the wind at their backs, like Shoprite. So I think, for betting people, I think it will come right, but I don't think it's going to come right in the short term. And I would argue you're probably going to have other bites at the cherry. So I think, although I do believe they will come right, and I think for betting people, as I said, there's an opportunity here. There are probably better opportunities elsewhere. I was mentioning the small and mid caps.
Yeah.
If I take companies like Cup, for example, where I would argue a lot of the hard work in terms of repositioning themselves been done. So they don't have to, find themselves, they know who they are, and they really just need to execute. And the multiples and things like that are ridiculously cheap. So arguably less execution risk and really good valuation. So yeah, I suppose it depends on what you're looking for. But I do believe they will regain, but I don't think they'll ever be, the market doyen that they were, or claim back the market share that they've lost over the last while.
Yeah, and they need Shoprite to stumble, and we're not seeing that. And of course, I think Sean Summers is almost halfway through his tenure. Ricus, Pick n Pay?
Yeah, I agree with Graeme. It's buying companies in a turnaround situation, which Pick n Pay is, as Graeme has just explained. Now, if they get it right, and I'm going to use two other examples recently, we were just talking about Mpact, the other one is PPC, where that turnaround seems to be working. Staying in Pick n Pay and waiting for that turnaround in the hope that it's going to succeed and you're then going to get a huge price increase, that's a gamble. Whereas if you wait for that turnaround to start tracking, then it doesn't matter if you miss out on the first 10 or 12 or 15%. Because as with PPC and as with Mpact, the rallying power in the price momentum can be so big that the first 10 or 15% doesn't really matter.
Yeah.
So to me, it's rather safe than sorry. Steadying around, prices going up, wonderful. There's lots of scope for further price improvement. And I would then go in rather than being stuck into something that might turn around, might not turn around, being part of, sort of almost being sitting on the same board as the management while they're trying to turn around. There's better avenues and waiting places for one's money and attention, frankly.
Yeah, I like that. And because, of course, the turnaround might not work, let's wait to see it actually working. Question coming through around Sun International. We saw the update coming out this morning. I got to say, it was a good-looking update. We've been talking about how rough it is for the consumer, but apparently we are out there gambling, holidaying, and conferencing. Graeme, Sun International?
Yeah, it's obviously, like all the hotel groups and the gaming groups, COVID really, wreaked havoc on the business models. But, from those levels, it's really been, that it's not a spectacular rise, but it's been a consistent rise. And I think arguably a lot of the hard work that was done, in the years preceding COVID, they're now reaping the benefit of that. So, yeah, if you look at it, again, you've got a business trading on a 9 PE, good yield. And if you do find, so what I'm saying is even in a difficult environment where disposable income is under pressure, and although you may still have reasonable footfall, the spend, I'm talking about from a casino, from a betting point of view, the aggregate spend is maybe not what it was. But yeah, it's looking as though they're doing the right things. If you've got to take a midpoint, let's call it about 12.5, 13% earnings growth in a 3% inflation environment, in the kind of operating environment that they're in, that's a very, very credible result. And the point is, it's not on a demanding rating. So, if you say we could be in a scenario where maybe SA GDP, blows us all away and does 1.5 or 2%, you could see this business continuing. So I think it's obviously come off a little bit in the last while, but I think it's definitely looking a lot better than it has, and they're obviously doing the basics right. So I think credit to management on that front.
Yeah, absolutely. Graeme, sorry, Ricus, Sun International, they have been, since the lockdown lows, heading up to the right side of the chart. Your take it at this point in the recovery?
Yeah, they peaked at about 44 Rand. I think they're about, 37 odd, something like that. So they've given back some of those gains. As Graeme said, if they can maintain earnings per share growth of 13%, let's say, at a current PE, as far as I'm concerned, they're cheap. They've paid off debt. I think the only operation or the only Part of their operations that's giving them trouble is Sunbets. The others seem to be doing well. They had pleasing results from their resorts, which is also very pleasing. I'm biased. I've got um, this is my hospitality share in my portfolios, but I thought, yeah, a very credible set of results. I think the price has come back too far, and it should track higher.
Question coming through around Aspen. We've spoken about it a lot in this show. Execution from management. It's having a really strong day today, looking good on the chart. Question is this perhaps some time to start picking up some Aspen? Ricus, your take?
I'm still waiting a little bit to see how much of the promise that they have in manufacturing, generics and products for Lilly and so forth actually comes through. There's been a history of sort of this, it's going to be great, and then it isn't, and then it's going to be great and it isn't. So they're still sitting with, you know, a capital investment that hasn't yet generated return. If it does, then it's going to be great. And in these uncertain economic times, it's also not a bad sector to be in, which is health, which tends to do well during times of uncertainty. So it's one I've got my eye on, but I would really like to see results coming through and the manufacturing really getting some traction for the plant they've built.
Yeah, and promises made, promises kept. Graeme, Aspen?
Yeah, so I think I actually believe the story. I think that what Ricus is saying is absolutely right. Some massive investments, for example, in Quebec, they built an incredible facility there. That will generate income. There are lots of people around the world looking for that spare capacity, and not only during pandemics. So I think, obviously the markets, I think since the results, very excited about, the weight control drug or weight loss drug. And they obviously talking that story very, very well. But I think when let's just strip that out of it and look at the core business. Obviously OTC was a little bit disappointing, but the rest of them, particularly in constant currency, actually look pretty decent. The normalized HEPS were around 12% up. So you annualize that, you've got probably about 15 rands worth of earnings, with quite a lot of capex and capacity that's really still going to come online and contribute. So I have a slightly different view to Ricus. I think we're at the early stages of the turnaround, and a lot of the capex has yet to really contribute, and I believe it will contribute. I think obviously, Trumponomics, we were quite hopeful about the opportunity for them to enter the US market. Obviously, Trumponomics is going to, put the capital pigeon somewhat there. But then equally, people were very worried about volume price in China, and that's now in the base, and you've seen China get going again. So I think it's a business that's actually got. I like businesses with lots of levers, and I believe they do have lots of levers. I think Ricus is bang on the money that the market tends to. I wouldn't say fall in love with them, but a lot of people in the market have a bit of a love-hate relationship with them. Obviously, from the days when they had too much debt and became too acquisitive.
Yeah.
But I think this business is moving towards a different phase of higher predictability and better execution, but you've still got the optionality around GLP and stuff like that. So I would say you don't have to chase it on a day like today where it's up 5% or whatever, but I think it's definitely one to add. I think the multiple and the prospects are aligning for a pretty good investment on a 5-year view, I think.
Yeah, okay, got you on that. EPE Capital Partners, one I haven't looked at in a while. Question coming, seems to be doing a little bit better. Still a liquidity problem, hard to get the shares. Is it worth looking at? Graeme, EPE Capital Partners?
Yeah, we know them quite well. Obviously, Break was unbundled, so there was a value unlock there. And with that exercise, of course, the net asset value came down from $10 or whatever quite significantly. But I still say the biggest asset in that portfolio is Optasia, which is an amazing fintech business, with, call it, almost $500 million underlying clients in the MNOs. Fantastic business, but quite a lot of others. So I think it is trading by appointment. You see bids down in 460 and offers 480 or 490. you don't have to pick them up at 490. Just if you like the story, and we do like the story, you can just sit quietly on the bid, and I would imagine in a week you'll get your stock. I think what's going to happen, I mean, management has, or the board has resolved they're going to effectively wind down that portfolio. So effectively, as the assets move into the waiting lounge, they exit them, cash will be either returned in the form of buyback, specials, etc. So I think it's a reasonably predictable one. And if you just look at Optasia, which we like, you're getting the rest for not a lot of money, and there's some good assets in there as well. So we like it, but don't chase it. You could probably get your stock at 470 or 475. So
yeah. Look, chasing has never worked for me in all my years. I've chased far too often, and I've still got my fingers, but only just. Ricus, EPE Capital Partners, is it one that you look at?
If you had asked me that question rather than Graeme first, I would have straightforward deferred you to Graeme. So I have absolutely nothing to add.
No, Graeme knows plenty. He makes up for all three of us on that one. Ricus, let's stay with you then. Rainbow question coming through. Excellent results, plus 1,000% numbers on the Friday result. Surely there's opportunity here. Ricus, they're not wrong about the plus 1,000% in some of the numbers. Of course, it's base effect and turnarounds and the like. And again, chickens, deeply cyclical, volatile. Would you be looking at Rainbow?
No. I stay away from the chicken business. There's a hugely contagious and deadly strain of avian flu approaching us from the north this year, as far as I know. It can possibly, or it won't, I don't know, which is why we're not into chickens, affect us. So this is a results based company. The variables are just too enormous and the margins are just too thin.
Yeah. And one of the variables is, will they be zero rated at the new budget on Wednesday, or, we'll leave it there. Graeme, we're out of time, so I'm going to come to you for stock picks. You're going with two stock picks, a local, ABSA, an offshore, Diageo. Talk us through the logic.
Okay. So on ABSA, Simon, let's look to December 26th. Understanding that 24, 23 were difficult times for them, but notwithstanding that, they'll probably give us 25, 26 rands worth of earnings for a company that's trading at 190. You do a quick calc, you've got a 7-ish PE, 55% payout ratio. By my calc, that gives you 6% after your 20% dividend withholding tax. But I think it's putting the steps in place to sustain those earnings over the longer term. So I think ABSA is just too cheap, but I do think that they're doing the right things. And then Diageo, obviously global spirits business, a giant in anybody's books, great portfolio. LATAM hurt them, and I think more recently, again, tariff threats have come down, so have caused them to come down. So my sense is that under £22, forecasts are for about $1.70 to maybe $1.75 on a 1 year rolling forward. Those multiples are right for a business that is, I believe, fundamentally defensive, but they're doing enough in that portfolio to actually sustain earnings growth. So the forecasts are fairly muted in terms of earnings growth, but I think you're buying a fantastic business that's largely defensive on a low multiple and a dividend yield, if memory serves, of about 4%. So
okay.
I'd rather be there than sitting in long-dated treasuries.
No, fair point. Ricus, Medtronic.
Yeah, as Graeme mentioned the defensivity, or the defensiveness of Diageo. The other sector that's also defensive in these uncertain times, strangely enough, is health. And that's normally because you're sitting with pharma companies doing a lot of R&D and getting wonderful products, and it's sort of that kind of profit is divorced from what's happening in the general economy.
Yeah.
But within health, there's also something called medical devices, and Medtronic is a company that operates in that field, has been doing so very successfully, and that also involves a lot of R&D. As I said, they've been very successful. They've had 47 years worth of uninterrupted dividend growth. They know what they're doing. And certainly in their very specialized fields, in terms of robot surgery, artificial intelligence, being applied to endoscopy, for example, some of their products. It's a hugely exciting business in terms of what's happening with robotics. And AI price has been flat for almost 2 years, down a forward P of about 18, upside from current about $97 to 110 or 115. Defensive and possibility of a share price increase.
We'll leave it there then. That's it for tonight's Stockwatch. Thanks to our guests, Ricus Reeders, PSG Hole in One, Ruimsig, Medtronic, Graeme Körner from Körner Perspective, Diageo and ABSA. Up next, The Close. Stay watching.